Okay, welcome everybody this afternoon. I'm Jim, the option professor. Quick background on myself. I've been in the investment arena here for many, many decades, and I've conducted seminars on option trading for people throughout all 50 states pretty much, and also in Canada. So on the uses and risks of options. And I have an alert service, option alert service that I'll get to at the end of the broadcast. And I know many of you have gone through a lot of information on the Elliott wave and Fibonacci today. I'm going to go over things in a little bit of a different way because I use the Fibonacci and Elliott waves as additional information, not primary information, on when I make my decisions on how to pick a winner. And basically, I do specialize in one type of option strategy. I'm familiar with all of them, but the one that I focus on is strangles, where you do calls and puts on the same at the same time. And I'm only interested in long strangles, which means they have limited risk and unlimited potential. And I try to use my indicators, which I focus on the trend and the momentum, because after decades of doing this, I found they're very reliable. Now, Fibonacci, is a mathematical situation. I obviously have a lot of respect for it, and it does coincide with a lot of my moving averages. Elliott wave also, has a lot to do with Fibonacci because a lot of these waves are retracing, the same amount as a Fibonacci number. So, and my moving averages. So there's a lot of things that come together here. And I'm going to try to just go through the stuff that I do, and see how coincidental the Fibonacci numbers and Elliott waves are. I'm basically going to review for the last 6 weeks some very winning ideas that I've had, and some of them have been very, very high percentage winners. So I'm going to show you how I came up with them. We're going to look to see how Fibonacci might fit into it, and then we're going to go from there. Now, I guess most of you already either know or have heard about, the Fibonacci numbers, 23.6, 38.2, 61.8, or 1.618, and of course 78.6, and then 50%, which is really not a Fibonacci, but they use it anyway. And so basically, those are the numbers we're going to kind of look at and see how many times my stuff gave me a great winning trade, and how many times it would have given me a coincidental or Fibonacci confirmation or an Elliott wave confirmation. Now, to be frank, on the Elliott wave, I find it to be very subjective, meaning how you get your starting point, and of course how you count the waves and get into all the different minutia of the Elliott wave. So on the Elliott wave, basically, I'm not using it that much, but I'm going to basically show you real quick what I see as Elliott wave. And it's a simplistic, basic way of looking at it. And basically, it's, the motive versus the corrective. And so if I'm looking at, the waves, I like to keep it kind of simple. Moving averages are pretty simple. They're a number, and I use the simple moving averages. So they're basically divide by that number, and then that. And then, of course, I've got my own averages that converge and tell me different stuff. But here's what I would say is the easiest way that I use Elliott wave. If I can count on the motive 1, 2, 3, 4, 5, you can see that the second wave doesn't take out the low of the first wave, which is similar to some of the Fibonacci stuff. And then, of course, the 3 wave is always going to be the largest wave. And then basically you pull back, and then you'd never go anywhere near the 2 or the 1 area. And then on up here, the similarity to what I do to the Elliott wave is the 5th wave is supposed to be coinciding with a divergence in the momentum. And I'm an extremely large believer in that. So basically, that's very coincidental to what I'm looking at. And as I look at my graphs and my ideas, you'll see that does come into play. And then the corrective phase, obviously, you go down, you come back up, you go nowhere near the high. And then the C wave is kind of like the 3 wave, meaning the C is where you really get the acceleration. I would imagine that my momentum indicator during a C wave or a 3 would also be going into levels that I know when I'm in those levels, there's a high probability of an acceleration. And acceleration is where the big money's made. That's where the momentum can go from 60 to 85, or it could go from 39 down to 12. And that's of course where, especially in options, where you're going to really get a really big roll for your money. So basically, that's kind of what I'm looking at here on the Elliott. It's basically a fairly simplistic approach, and if they're very identifiable, fine. But if you see a lot of back and forth choppiness, then of course I just wouldn't look at it. And that's just, again, today is all my opinions and my views. So obviously many people have different views. So that gives you a little bit of an idea of the Elliott wave situation that I think might have some merit in what I do. Okay, so going back here on the S&P, I heard Avi was talking about the big picture. I absolutely believe and agree with him that there is a very, very large corrective stage that is probably going to happen in 2025. And so the reason for that for me is, as you can see, I use some moving averages here that I've tested out, and I think they're the best. So obviously, it's my opinion. So we've got averages down here at 120, which obviously very rarely gets hit. Only through the crisis of COVID do you even get near it. And then, of course, we've got the longer term one, which is down here at 250. And so, that probably would never get hit unless, of course, you had some kind of a nuclear blast or something. But could you come down to the 4,500? I think that's minimum what'll happen in 2025 if there's a good corrective stage. And then I think Avi was talking about something like 3,800. Well, maybe if it takes 6 months, maybe the 250, the 120 will be up near 3,800, and then it'll look something like this if there's a big drop. Okay, but I'm a believer in reversion to the mean. Again, I've been doing this for decades, so I mean, I've seen all this stuff, and this is where I've come to conclude. You're not going to find me buying way up here away from the averages. When you come back down, I'll start talking. Obviously, if you're under it, I want no part of it. But if my averages are rising, I know that this is probably a bologna sandwich, and once it gets back above it, I'm all in. And then if it gets back above red, I'm really all in, and then I'm going to ride it. I'm not going to get into the market up here. I'll be saying reversion to the mean, which is what I'm saying now. So the bottom line is here. I'm looking for reversion. Once you got back towards blue here, again, you're going to violate it. But these are all, in my view, people stealing your stock before it goes back up. And in other words, they're trying to make it look like it's going down. Obviously, you're getting stopped out. Obviously, people are panicking. They're not noticing that there's a former high here that's support. And so basically, once it pops back above, this line is rising. And then, of course, when red joins in, that's really strong. So, it was really obvious to me at the 4,000 and 4,100 area, these two neighborhoods here, that it was real obvious to get long the market. And then when, Powell started talking about cuts in 2024, I mean, that was all you needed to hear. And then, of course, what makes it really go is something like, AI. In 1929, it was the radio. In 1969, it was going to the moon. In 2099, it was .com. So what's making you go nuts now is the AI. Of course, you might also realize that all those stuff became mature, and when they become mature, they can't hold the thing up. We seem like we're in the early stages of the AI thing. So anyway, what am I looking at here? I'm looking for some kind of a pullback. Now, if we measured it out here from this starting point of 3,500, let's do that right now. And we'll take 3,500 as a base, a starting point. And then we'll go to the top here, which so far, I think, let's call it 5,670. And we get 2,170 points. And say we take a 61.8% deal, that'll give you 1,340 points. And so if I take 5,670 minus 1,340, I'm going to get around 4330. And so this number comes in right now at about 4,500. So could it overshoot a little bit like it does here? That could be very well possible. So again, your bare bones minimum, if they wanted to have a reversion to the mean, you would want to make plans on that neighborhood being a neighborhood to keep an eye on. It's not an exact Fibonacci, but it's in the ballpark. Okay, and so basically, that gives you an idea of what the potential might be and why it would be there. Because if we had a full Fibonacci retracement. So that gives you a little bit of idea on the stocks as far as that's concerned. And let's take a look at a couple of other, well, I'm going to show you some of these things that we've been doing. I'm going to start this in the last 6 weeks. Okay. KRE, banking index. Okay. This is where I came up with the idea. This is why the idea worked. And it also coincided a little bit with the Fibonacci. So I'll give you an idea. Just what I'm trying to do is give you some real examples of a real trade and a real example of how Fibonacci could work for you. Okay, let's go here. And I'm going to go to the 1 year. Okay, so we were up here at 60, okay? And we had come up from 48. Right. And I noticed there was a lot of earnings coming out with a lot of regional banks. So I thought that could cause volatility. Now, again, because we were up here, we had gaps to be filled. Right. And we were up here. I thought that it was a good time to do a strangle. So my idea was to buy a 61 call. So just in case it keeps going, I'm going to be protected on that. And then, of course, a 58 put, because, again, I'm looking for a reversion back to the mean. Okay, so that cost $175, maximum risk. Remember, limited risk on each side. Okay, and I got a 61 call and a 58 put, right? And that's all the risk I'll ever have on that trade in my whole life, $175. And what happened was we reverted back to the mean, which I considered to be the blue line. We actually even went through it. So that $175, because the 58 put went in the money by $6, $175 jumped to $600. And then even more so. So the bottom line is that this is a classic example of why I like strangles. It's also a classic example of reversion to the mean. Now, if we measure this thing from the starting point, which is what? The low right there. What's the low? 47.67. And then we go against the high point, which I believe was, let's call it 59.59. You get a total of, let's call it rounded up, $12. Take 61.8% of the $12, you got $740. So you go and take that high point again, 59.59, 740, and you're at $52. You see? So right exactly where my blue line was. Now it overshot, but it was right to the number as far as I'm concerned, right? So there's a classic example of my stuff and the Fibonacci stuff working in concert. It's also a classic case of why strangles make a lot of sense if you have your timing down straight, which, thankfully, in the last 6 weeks, we've had the timing down pretty well. Let's see some other ones here that we've had. Such as, and see what kind of corrective thing. Intel was a very big situation for us as far as percentage gain. And let's take a look at why that, well, I'll tell you why I did it, and then I'll show you what's going on there. So again, Intel was trading down here at about $30 with earnings coming out. Sometimes I use this at earnings. Again, I'm only interested in one thing. I'm trying to make some money, and I want to keep my risk limited at a relatively small amount. I don't know if how many of you saw the Big Short movie, but the guys in that garage that turned 100 grand into 30 million, they said their whole idea was very simple. What was it? That people don't think that the opposite thing that's going on will ever happen. So they charge very little for the options. So when they do happen, the option explodes in price, right? And when it doesn't happen, you lose a little bit of an amount. That's not a bad idea as long as you can find some winners. So here we go again. We're at $30 here. It's already jumped up to the reversion. So when they had earnings, I thought, frankly, that it might revert back to the purple. Why? Because they're talking about the government giving Intel all this money. So the 32 call and the 28 put was like $175, right? Limited risk. Now I'm thinking it's going to 34 and I'm going to make money on the call. But what happens is they announce very bad earnings and it drops down to 19 in 2 days. And the put that I paid $50 for goes up to $900. So there's a reason why, like I say, my technical stuff plus other things can be a very, very effective way of trying to obviously use the technical indicators to make quite a bit of money. Let's look at the Chevron company. That was another one that we thought was going to make a big move. And again, when I get a consolidation of all these moving averages at one price, like I did right here, in my view, it's not going to stay there. I always tell people this is like a traffic jam, and a traffic jam doesn't last forever. Let's look at the longer term graphs and see if there was a reversion. You see, you got the gold line down there. This is a reversion to the mean. And this is why you have to look at the long-term graphs and the short-term graphs. If you don't, you're going to miss the boat. What about on the 20-year here? Look at this. This thing can go down to 120. In fact, it looks like it's trying to do that as we speak, right? But we do know this. When all of this stuff is in this consolidation and the red is already turned down, okay, and the momentum is already weakening as well, then you have a situation where you see the momentum is turning as well. So you got a lot of reasons why you do a strangle here, because obviously oil can do anything it wants. But the way I was saying this traffic jam, we go 160 call and about 149 on the put. And obviously we go all the way down to 140. The put and the combination costs a little over $200. And the put goes to from 149 to 140. That's $900. Obviously it's even lower now. So a lot of people, this is a classic example of people don't think bad things will happen, and they also don't think very good things will happen. And if you can find the right time and the right price, the strangle strategy has a lot of merit. I know it's not the most complicated strategy, and I know if you don't, but I do know how you lose at it. You lose at it if you don't find a stock where the premiums are reasonable, where the expiration date will cover the volatility you anticipate, and that the underlying will not get the news or events that it needs to be volatile. And obviously that's most stocks, right? And particularly after they make a big move. So after they make a big move, it's much more difficult to make money on them because the premiums are increased, and it'll be very difficult for you to overcome that. Or if you do, you're not going to make much money. In other words, if you pay $7 for the call and $7 for the put, you're in there for 14, 15 bucks. So that just to double your money, the stock would have to go, 30 bucks past those strike prices to make any money. And that is going to be a rough racket. So again, that's why the difference between knowing how the options work and not knowing is a big factor. But that's another example of why the strangle makes a lot of sense. As far as Fibonacci is concerned, I mean, when we drop from 162, right? And then you take away the low of 140, your $22 move, right? And so 22 times 61.8, what do you get? You get about a $13, $14 move. Well, where did it top out? 13. It went up towards 150. So it didn't go all the way to the full Fibonacci, but look where Fibonacci was waiting for you. Look the moving average here. The blue is right at 152 almost. So, it's not going to be an exact science, but between the Fibonacci number and the blue line being right there, that would be the neighborhood to start hitting it. And you know what? If you can find the neighborhood to get a good idea, you'll probably do fine. Unless you're these persons who are playing for like one tick, you go like, 1 second charts or 5, whatever you're doing. So if you're looking at a little bit of a broader picture, these can be very helpful. And again, moving averages coinciding with the Fibonacci makes a lot of sense. And again, I love Fibonacci because, again, it is mathematically oriented. And so it does fit into my trading scheme, which is using moving averages, which are obviously based on time and price, and then putting in there a Fibonacci number, which is also a mathematical formula. Again, with the Elliott wave, you're trying to, just be very frank. I've been following the people with the Elliott wave for a long time, and it can be a very dodgy thing. Robert Prechter is one of the leaders in that area, and he'd be the first one to say that he's been absolutely wrong on saying that the high point in 2021 was supposed to be this highest point we'll ever see in a long, long, long time. And now we've gone to 5,700, which is, a good 800 points, 900 points above the former high. So, I don't want to be that wrong on anything. So that's why I'm very careful on what I look at everything. But, this stuff that's based on the math, the moving averages and the Fibonacci's, much more interesting to me than the subjective nature. And, to give Bob Prechter his good points, he also called the bottom of the commodity sector back in 2020, I guess. And he was 100% accurate almost to the penny there. So the Elliott wave does have its place and it does have its merit, but I personally, will use it as a coincidental indicator or just additional information that I would put into my decision making. But again, the subjective nature makes me a little uncomfortable. Let me show you a couple of other things that have worked out really great for us. This was another idea we came up with. This was, and of course, we benefited from the Japanese carry trade being unwound. But this is the IWM. And we had some August expiration contracts here when we were up here at 225. Now, remember what they said about the Elliott wave, how you're going to have a what? You're going to have a divergence when you're at the fifth part of the wave. Now, I don't know if this was the fifth part of the wave because I don't count that well, but I'll show you why I thought it might be a situation where it could drop is because right here, look what your RSI is, you're 75, and then over here, you are at 63. So again, that is a divergence, and that would be right into the Elliott wave on why you would do this kind of trade. Now, again, what did we think was good? What was a good idea as far as I was concerned? In this one, it was a 235 call. Because you got to protect yourself in case it goes. Just because it's out of steam here on the RSI, it has a divergence, doesn't mean it's definitely dropping. So you want to have something protecting yourself. And then basically, we're looking at the put, 233 was the call and 217 was the put. So again, we're a little bit above where the market was and we're a little bit underneath where the market was. And the cost of that was $324 on that particular idea. Maximum risk, $324, right? What happens next? Again, what do I believe in? Believe in reversion to the mean. Where's my mean? Right down here, right at the purple. Did it go through all the way to gold? Yeah, it did. And what happened here, this was on August the 5th when the unwind was happening. So that goes all the way down to, as you can see, 196.70. And of course, the 217 put at that point was in the money by over $2,000. And of course, out of a 324 fixed risk, that was not a bad situation. So again, another classic example here. Now, I wonder if this here went up to 78% Fibonacci. Let's take a look, because that might have been helpful to know. Where are you here at the top? You are at 228. I'm going to round these numbers off, make it easy. 228. And then on the bottom here, you are at 204. So here you are. You had a drop of, wait a second here, 196.70. 196.70. So let's call it 197, 228 minus 197, and you're at 31. 78% of that would be 24. So if you took 197 and added 24, where would the throwback take you? To 221. Hey man, that's pretty close. That's pretty close. So again, that's why the Fibonacci numbers can be very, very helpful, because they do give you the retracement levels that might be very accurate. Okay. So again, but what I'm trying to say here is if you can combine, like, again, you could have done another strangle up here after it went up. Okay. And say you went with a 225 or a 230 call and a 215 put, and you only pay a couple, $3, $4, you're already to the good on this drop now. So again, I think that the strangle strategy can be a very good strategy because it keeps that risk limited. Sometimes when you work with Elliott wave, it can get very wildly against you. And that means your account's going to have a big drawdown, which means you're going to have a lot less capital to work with. And so the strategy that I'm talking about with the limited risk strangle at certain points of time. You can't do it after the premiums are huge. You can't do it after the market's already made its move, because again, when the premiums get large, it's difficult to make. And that's where everybody says selling the options is such a good idea. And it is a good idea statistically, except for one thing. A guy here is selling puts all the way up and he's got nothing to worry about. And he sells a put up here for, $100, and then he has to buy him back for $2,000. And if he has a decent amount of contracts, that is going to hurt. So that's why, again, for people who have risk capital and are trying to make capital increase with a limited risk, I've gravitated to the strangles, and you can see for a good reason. Let's take a look at another reversion to the mean, which was Apple back then. And again, these all happened pretty much when we had that big drop, that big spike in the VIX because of the Japanese carry trade, which of course could get unwound again at any point because the dollar yen today hit a very, very low amount again. But here again, we were up here, and we were up here at this area right here of 225. Okay. And so when it gets into this neighborhood and earnings are coming out, it's not going to stay the same in my view. So I'm looking for volatility. This is where volatility is lower, right? And I'm looking for volatility to pick up dramatically. So you take a look at the call option, and you look at the strike of 227. So you go a little bit up there near 230 on the call, and maybe something like 210 on the put, and looking at premiums of about $400. If you drop down and revert to the mean, it didn't go all the way down to the mean, but it certainly went down pretty good. And you're looking at the put options jumping up to like $1,700 or something like that. Not too shabby. Okay, so you got a pretty good run there too, or $1,500. And again, a classic example of when people are in this stock here, if you told them it's going to 195, they wouldn't believe it. I'll show you a couple of other markets where it can just go back to it can revert to the mean, and it can be very good. Shopify got people a little bit off guard, and that was a good situation as well. Again, we look at all the different stocks and all the different earnings reports, and we try to come up with the right idea. The right idea is something that is knowledge, experience, and obviously instinct. And those are the three main factors. But you can see here that when this thing was down here in this area here, right, this is called playing it for reversion to the mean, right? They had earnings coming out. Retail sales have been very strong. The people are still working. It's 4.2% unemployment. Wages are still rising. Why wouldn't Shopify be doing decently, or at least better than this? And so bottom line is we looked at the call options before earnings, and we looked at the call options in the area of 62. Yeah, just a little bit above 60, so 62. Okay, and then we had to put it 49, just as an insurance, right? So basically, that was $275 total risk, and boom, we went all the way up to 75, and that meant the calls were in the money by $1,300. From 275, that's nothing to sneeze at. So again, if you can get into these things, again, either when they're reverting to the mean, or like in here, where you have all the moving averages congesting, and it's not going to stay in this traffic jam forever. And if they're, again, a little bit out of the money and a little bit out of the money, and then boom, especially when you got the indicators pointing down, you should have known this was a baloney trade because everything's still pointing down. And when you get an aberration, when everything is still pointing down, that's all it is an aberration. And it's very helpful because, you're not going to get sucked into what they call an aberration. Okay, you know what I mean? So it's a good situation. And can you see we reverted right back to the mean? So I don't know how far that was. Let's go check it out. The bottom there was at $48. And if we measure it to the top here at about $76, you're looking at a differential there of 28. And let's say you take 23% off of that, and that takes you about $6 down. So, $6 down takes you around 69. That came in pretty close to where my moving average was, which was 67.68. So obviously that's why it's bouncing out of there. It's a little Fibonacci correction, and my averages are sitting there going, we're not breaking. We're not breaking yet. That's for sure. So that was a couple of them, and we also had a couple of good ones with Affirm. And I'll show you that one as well. In fact, that one's still alive and well because it doesn't expire till September 20. So I'll give you an idea here on Affirm. Affirm is a company that obviously gives out credit to people. If you ever go in a Jiffy Lube or something like that, you'll find they have a sign up. So if you can't afford to fix your car, Affirm will be kind enough to give you the money. Okay, well, a firm also is in a similar business as far as lending is concerned to this company here. And this is called Upstart. Now, the reason I thought a firm might go is Upstart announced their earnings, and you see how it went from down here way up here. So I extrapolated over that a firm in the lending business, people have jobs, people are earning wages, people are spending money. They probably have good loan and credit card usage at its all-time high or something like that. That's what they're in, credit cards, right? Credit. So bottom line is we looked at this thing and we went out when it was down in this 26 area neighborhood, and we thought it was going to turn. And basically, we went a 2750 call and a 2250 put, and it went for about 377 bucks. That was the idea. And what happened after earnings? The thing went all the way up to 46, and the calls went up to as much as like 1,700 bucks or more. So again, you're in a congested area that's not going to last. You've got news coming out. So this is a very effective way of speculating, which is what you're doing when you're doing a lot of this trading, right? Speculating and having a limited risk, but also having a very large potential gain. Again, I've been in the business a long time of investing. I have, your treasury bills and your real estate and your stocks you never sell. And then you have some money you'd like to make a lot of money on, right? And again, it's going to take leverage. It's going to take limited risk because you only have so much. And it's going to have to take making good calls. And if you can combine that, this kind of strategy can be very, very effective for part of your capital. Again, we also take advantage of things like bull call spreads. NVIDIA. Now, NVIDIA obviously, had a great quarter, right? But they announced design problems with the Blackwell, delay on the Blackwell, and of course that got people a little bit nervous. But it really is only one thing. It's a reversion to the mean. I mean, this is why I do this, okay? Because 140 is going to come down to at least 125, if not to the blue line of 120, if not to purple at 100, if not go through and go to 90. We just did it again. So down here, my idea was a 104 call, 114 put, buying a 104 call, selling the 114, $4 out of your pocket, ballpark. And if it goes to 114 or better, you can take 10 out. Went all the way to 130. Now, last week we were down here at 100, and for a long-term speculation, we went all the way out till March of next year, and I believe the strike was something like 110, 130. And if we can go back towards 130 by the end of the first quarter next year, a relatively small amount of money is going to go to a high multiple of that. And again, this is where I'll play ball. Not up here, not up there. Okay. You play ball at the right time. That's my view. So I thought here was the right time. There was the right time. If you want to get NVIDIA, you don't want to pay $116, for on 100 shares. 100 shares at 116, is 11 grand. If you did 1,000 shares, you're at 116 grand. On the call spread, you're putting up like 4 grand. And if you're wrong, you lose 4 grand. If you are wrong on 116 grand or 140 grand, 140 grand when it comes down here is only worth 100 grand. That's a 40 grand drawdown. How's that stomach going to feel? It's not going to feel very good. Okay, so at least these limited risk ideas, yes, they can lose, but they do have a cap on them and they do have staying power. If you could only lose 4 grand on a trade ever, and you get a big drawdown, that's going to be a lot different feeling than if you have 140 grand here going down to 100 grand or 90 grand, now you're down 50 grand. You don't think you're going to get a little bit possible that I'm in the wrong thing and this is going to be a crash? I mean, it can be very, very hard to hold on through all that. So that's why sometimes the limited risk options are a good alternative for people who they want to sleep at night knowing they have a fixed risk, and they want leverage. So basically they get both of that in this kind of an idea. So anyway, that gives you a couple of things that we were looking at here. And I just also wanted to go through some of the different markets and give you an idea, because right now, well, I'll show you one that we had 3 ideas in a row, 3 weeks in a row. We did the same idea pretty much, and I'll show you why. Google. Okay. Where are you, Google? All right. Google's at 152, but it went up at 152. Now, remember I told you about a traffic jam? This is called a traffic jam. This is called a downtrend. So a traffic jam and a downtrend with the RSI under 50. This thing is weak, but I could also see how it could come up and fill this gap. So I want a strategy that puts me on both sides of this thing. So back on the alert that I sent out on the 18th of August, expiring on the September 20, was a 170 call, and the stock at that time was like 165, 170 call and a 160 put, and the combination of both of them was 348 bucks. This thing comes down here to 150 or 148 here this week, right? So what is the 160 put going to be? It's going to be in the money by about 1,200 bucks, right? Now the next week, I hit it again with an idea of 172, because see how the market went up a little bit? So I went with a 172, 162 strangle, buy call, buy put. And we were in that thing for about 460 bucks. Well, that thing down here at 148 is now looking like 1,400, right? At that point. And then basically the last time I hit it was on September 1 alert with the idea of the September 27th expiration. And here we're again at 170, 160. This time it's 400 bucks. 460. Again, 1,200 bucks down here. So, you know, when this is like this, I am a believer of volatility and reversion. I thought it was at least going to go down here, and of course it overshot. Now, you know, will it be able to come back up? If it does, what would the measurement be? 170 bucks and 148 is what? 170 minus 148 is 22 bucks. 61% will give you 13 and a half. Let's give them 14. 148 plus 14. Where would that bring you to? 162. You see where the green line is? Where's it at? 162. You see? That's where my moving averages and the Fibonacci numbers are very coincidental. And I'm trying to tell you, it's something I really believe in. Okay, so anyway, there's been some other ones here that I could show you, but I think you get the idea of what we're trying to do here with the strangles. And again, the risk on a strangle is you don't get the volatility and then the premiums go down. But of course, you have the ability to get out anytime you want. So if anything's not working, you can cut and run, you know. And, you know, again, since I do these alerts weekly, every Sunday night, I'm scanning the globe looking for the setups. I don't care what the name of the company is, as long as they got tradable options. I don't care what sector it's in. Sometimes I care what sector it's in because, like I say, well, I'll just give you one last one real quick here. This is Fortinet, FTNT. They came out with some earnings or something or other, right? And not Ford Company, definitely not Ford Company, that's for sure. Okay, Fortinet. All right, Fortinet, you know, had some earnings come out, and check this out. Boom, 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 right? This is cybersecurity, right? Everybody needs this cybersecurity because everyone's trying to hack into everything, right? So, and of course, cybersecurity with CrowdStrike got whacked with Delta Air, and I think that's an unfinished story because according to Delta Air, they lost $500 million with it, and obviously somebody's going to have to pay somewhere. So the bottom line is that these guys got a nice bid out of it plus their earnings. Well, I thought if these guys are taking off and Palo Alto looked pretty good, let's take a look at Zscaler, right? And so I take a look at Zscaler, and Zscaler was coming out of the darkness. Well, kind of like Upstart and Affirm. Well, that's Zscaler and Fortinet, right? Same looking chart, right? So what do we got? We had a situation where Zscaler was way down here, kind of like Affirm was. One of their competitors had taken off, and we had gotten to a point on Zscaler where we were looking at it just got above 170. So I looked at the 182.50 call and the 155 put, just in case it was going to collapse. And the combination was 379. limited risk, total risk, that's all you could ever lose. And what happened is we went all the way up to 202, which took the what? The 182.50 call up to $2,000. Now, of course, look what it did. It came back down. So again, if you had bought a little bit more time, you could have made it up and down. Or you could roll the position up, which is where you make a gain on this up here, and you go to a 210 call and a 190 put, and bam, you would have got good action on the down. So that's why limited risk strangles are something that I think are very good as long as you can make money at them by picking the right ones with the right time, with the right premiums, with the right news coming down the pike. And of course, that's why people go to me to try to listen to my ideas, because I do a lot of homework on this. It takes a lot of time and effort to come up with these ideas. And so that's another reason, people subscribe, is they want to obviously see what the heck I've come up with. Okay, so that just gave you a little bit of an idea of another situation where, you can also see what's in the sector and then jump on the train that way as well. I was going to show you two stocks real quick. Summit Therapeutics made a big move. This is kind of big in the news right now, right? And I looked at it here and I thought it was kind of interesting because these guys came up with a drug that is going to compete with Keytruda, which is the big drug for Merck, right? And so Merck makes like 45% of the revenue off this drug, is what they said on TV. That's a lot, right? That sounds like a lot. And this drug supposedly is 49% more effective in this phase 3 trial that they did over in China. So I don't know if that's going to be a factor on whether it's going to be feasible or not. But this thing here today did get some rollover, right? And so if in fact it's not going to be able to take out this high points here, which we'll know very soon, because this is, again, where we saw some divergence here. And again, according to Elliott wave, that's the end of the cycle of number 5 sometimes. Okay. Again, the problem is if you change the daily chart, it can change the whole thing. But anyway, we're up here at 75 and over here you're at 69 and now you're back in the 58s. So if this thing is going to roll over, and if they have any question on the veracity of the phase 3, this may have some significant potential on the downside, but you'd have to wait for some type of a down move on the red lines, and you're just not getting it. So this is a very aggressive idea, because this thing could also keep going up to $40. It could be a buyout candidate to Merck. Maybe Merck will just buy these guys out, and that takes the competition out. So this is something to keep an eye on. And of course, Viking was one today, because again, the biotechs are definitely getting a merger mania out there a little bit, possibly. And so VKTX is another one that, again, we're looking at a situation where there's something happening here as well. And again, after the pullback here, another easy Fibonacci thing. Where are we here? At the low point, you're at $51. And then at the high point here, you're at about 56. And so you had a $5 move. And then if you take the 5 and you take your 61.8%, you're at $3. So where did it pull back? It pulled back from 56 to 53. So there's another classic case, Fibonacci pullback and then take off. But again, I wouldn't have put it on the Fibonacci pullback. I would have bought it as it broke above my red line, because I want the trend to be up. I just don't want to hold on to a Fibonacci number. But it's a good coincidental indicator that would have given me confidence that at $54, I should be playing this thing from the long side, particularly if I'm a short-term trader, because that chart would be telling you get in now. And then, of course, you'd put your stop under $53 and let it ride. And that's exactly what been the good thing to look at then. We've got 15 minutes left, and I was going to give you, because I heard Avi was talking about the big picture, right? So let's talk about the big picture, and I'll show you my big picture. I already showed you on the S&P, right? Now let's talk about the QQQ. There's your tech sector, right? So let's see what that looks like. What's happening there? And I'm going to go to the long-term graphs, because that's the big picture, right? Okay. In the big picture here, let's go to the 5-year. That'll encompass the highs and everything. Okay, so here we had our momentum up here in the area of 73, And then, of course, it ran out of steam. Watch, 73, runs out of momentum, 63, and you go in the tank. Here, you got your momentum indicators peaking out in the area of, let's see, around 70. Up here, you're at 73. So it's a little bit higher. You don't have much of a divergence that way. But is this just a Fibonacci retracement? Let's find out. The high point was what? 503.5. Where's the low here? 423. Okay, and you got a 61 there, and it's going to give you about 49.50 bucks retracement. So where would 423 plus 50 bucks? You should be peaking out somewhere around 475. So where did it go? It went to like 485. So it went through it a little bit, but look where my moving averages are. Can you see 475 right there, the 12? You think that's just a coincidence? I don't think so. So I would be watching the 475 area if I were you, like a hawk. Why? Because if it fails at that level and takes out my blue line here, which is coming in right there at 450, okay, then you could have a situation where you could make a case that it's going to be topped. But right now, it looks like getting through my number here, which comes in at the 475. If you get above 475, it's probably going to take out that 480, and you might even go down to new highs, because look at that RSI right there. That looks like a base. So we're in a very critical point here with this NASDAQ QQQ, and I would look at that 475 number as a very important number, 475. It coincides with the Fibonacci, and it also coincides with my 12 SMA. Let's turn to the semiconductors. Because this is where all the racy stuff is here. And then I'm going to show you a couple other things you definitely want to keep an eye on for the macro picture. Okay, obviously that doesn't look very good. The red line's pointing down, and the bottom line is this thing just could go, what do you got, 80 points, let's call it. So 80, let's just figure something real quick here. That would have been a 48 point drop. 40. Yeah, there you go. This thing should have popped up about 48 bucks, 50 bucks off the low for a Fibonacci retracement. Okay, where did it go? 250. That's pretty much to the number. So 250 is your big number for semis. 475 is your QQQ. You want to worry? You want to use numbers? Use those numbers. I think they're very key. Again, the blue line's rising though, and again, these averages have not crossed. You're not going to get a big down move in anything unless these babies all cross over. Just doesn't happen. Okay, in my view. All right, so there's your tech. How about we look at oil? You know, oil is obviously very low now. So is it telling us anything? Can we see anything from it? Okay, again, you know, from on the 20-year basis, this thing broke. Okay, but it has still not broken under purple. So you want to have the last man standing. It's 62 bucks a barrel. 62 bucks a barrel. Okay, on the 5-year, it broke under gold. So you got some support on a long term at 62 bucks, and you got resistance right there at the gold at 71. So in my view, 71 to 75 is big resistance, and support could be at 62. Underneath 62, this is called the abyss. Okay. And again, there's three things you got to remember. This market peaked out a year ago at about 80 bucks. Okay, a year ago, right around 82 bucks. The dollar index peaked out a year ago. And they all reverted to the mean. A year ago, well, let's just, yeah, right here. 107, right? And boom, 106. And it's had a big drop. The other thing is interest rates peaked about a year ago. Here's your 10-year note. See, it peaked out 5%. So the dollar's peaked, oil's peaked, interest rates have peaked, but what hasn't peaked yet? This guy here hasn't peaked yet. Well, it's peaked, but it hasn't rolled over yet. Now, if it takes out the peak, ball game's over. But is this the next one to go? And I guess that's what Avi's saying. This is the next one to go. And then what about this guy here? He's the other guy who hadn't gone yet. And this is our old yellow metal, the barbaric relic called gold. And as you can see, gold hasn't peaked yet at all. But what's interesting in gold, let me show you here. You've had 83, which is your in 2020, that high point was at 83. Next high point was 60. Up here, you're at what? 77. So again, it could be a situation where this is an up flag down pole coming. Let's see if there's any other evidence of exhaustion. Here you got a what? You got an 80, followed by a 63, and followed by a 69. That to me is a divergence. Okay, so divergences can be rectified by simply spiking up, or it can be rectified by reversion to the mean. So again, with those other markets having already rolled over, I would be keeping an eye on gold, and clearly under 2,500 would be a very good warning sign, and certainly underneath 2475 would be a further warning sign. And if you really pulled back in gold and you want to see what a reversion could look like, that's what a reversion could look like if there was a significant reversion. So again, running around thinking gold can never go down could be a flawed idea if we don't resolve this momentum exhaustion that is shown right here. And again, I can't count Elliott wave as well as other people on these panels. So you might ask them what they think about, are we counting 5 waves up? Because if we're counting 5 waves up, I've got some evidence of exhaustion on the 5-year graph. And that's pretty good evidence, because that's 77 and this is 69. And that's like almost a 10-point differential, which is pretty reasonable. So again, right now, I am going to spend a few moments. What else did I want to do? I showed you the gold. I showed you the tech. I showed you the stock, S&P. Oh, yeah, let me just show you a couple more quick ones, and I'm going to go into something else. Bitcoin. Let me show you why I told people to avoid Bitcoin until something happens, and I'll show you when. Okay, on my 5-year graph, I have a wall of convergence coming in right at 65,000. So I told people in my updates that I give out every week, do not get excited about Bitcoin until you get a sustained close about 65,000. Why not? Because according to people, Bitcoin is going to go to like 150,000, right? So who cares if you got in at 70 or 75? If it's going up to those kind of numbers. But you know what the problem is? If it's never going to get above 65, and last week it had a chance to do it and failed, it can go all the way down to 35 grand again, because that red line's pointing down. So you certainly got to get above 60 to even talk about it. And to make money of any size, you got to get above 65. So just remember this chart, because this chart, I think, has some pretty good and reasonable points. Now, let's just do a real quick fib here on Bitcoin, and then we'll call it a day here. The low there was at 38.5. 38.5. Okay, and then let's take the peak. Where are we here now? 38.5. And then the peak here was 74. So where are you there? You're at 35 grand. You take your 61% off. You're talking about 22 grand. If I take 74 grand and take away 22, what would that take me to? It would take me to about 52 grand. And look where the low was. Okay. So that's very positive, because if it doesn't take out, that's a good place to put a stick in the ground. If it cannot take that out, and it takes out 60, and it takes out 65, get bullish on Bitcoin. There's your numbers right there. All right, it's 5 minutes before I got to shut down, and I don't want to get cut off like I was last time. I just want to reiterate, I'm Jim, the option professor. What do I have for you? I have a options alert service. What do you get in the options alert service? You get for free, you get an options master class What does that do for you? It gives you 3 sessions and 6 hours of comprehensive information on how options work, what are the uses, what are the risks, and how do you trade them, right? And myself and Dan Siddick put it together of trading indicators, and there is no question there's things in there that'll help every level of trader, from beginner, intermediate, or advanced. That's what you get right off the bat for free. Second thing, you'll get my alert every Sunday night. What do I have in the alert? I have my ideas on what I think looks like very good strangles, limited risk, big potential. And you get quite a good number of them because obviously the volatility is there. Plus, I do a lot of work to come up with a good amount of them. You also will get some bull call spreads on long-term options, like we just bought into NVIDIA when it had the big drop just last week, and we went into bull call spreads there. Secondly, we are going to give you an S&P each week, and we'll show you what I think looks like a good range or a good trend for the week ahead. So they'll get S&P, I guess you would call it a swing idea. You're going to get strangles that I think look like very strong potential. And you're going to get my market overview each week on the stock market, on interest rates, on the US dollar and Bitcoin, on the price of oil and the price of gold, and the international markets, because I follow these things all very closely. So it's a one-stop shop to learn about options, to get some ideas, to get a comment, to get some ideas on S&P, and to get some commentary on all the different markets, because again, those international markets may have big potential looking forward. And also Bitcoin maybe get into, maybe something to get into, or it might be something to avoid. I'm right on top of it. And then of course, there are certain sectors like energy, metals, banks. I've got strangles going on those banks now. Okay. And so those banks obviously are getting hit by that increase in their reserve requirements, plus the hit on net interest income. JP Morgan just told you that. So there's volatility out there. I'm out there trying to find it. And every Sunday night, you'll be able to get it. Now, again, we have an introductory rate where I give $100 off. Normally it's $197 for the month. We're cutting it down to $97 for new subscribers. So you can get a hold of me at optionprofessor.com and put your information in, or you can go to optionprofessor@gmail.com. And you can also put up your contact information, and I'll talk to you personally, no problem. And so those are 2 ways of contacting me. And then if you'd like to take advantage of the options alert, because again, we'll have a new one coming out this Sunday before the Fed meeting, and that could be interesting. So basically, I think David will have some kind of a link that you can click on, and you can either subscribe right away. It's month to month. So if you don't like it after a month, you're going to keep your options course, and you'll have information for a whole month to see if it's for you or not. I don't think people are going to be leaving too far if the ideas are continuing to be pretty outstanding. So obviously, my job is to keep finding good ideas, and then the people obviously stay. So again, I ask that you give it a try. Optionprofessor.com, or again, David will have something he'll put up here, and it'll be a link that you can click on. $97, I think, is obviously a joke for getting the information for a full month, getting a options class that you can keep for the rest of your life and use as a reference guide. And if you have a question, I can give you my contact information, and of course, I can try to help you if you had any questions as well. So again, I think we're at the top of the hour here, David, and if you can